Okay, guys, today we're going to take a look at Moodys Corp. Now, I know that Joseph Carlson really likes this stock for some odd reason. It doesn't really make any sense in my mind based on the numbers that we're about to take a look at in this video. But let's their past 5 years they have had strong performance. They have outpaced the S&P 500 over the past 5 years, so that has been good performance. It has been a volatile road though. It does look like they did drop quite considerably during that bear market. They dropped all the way down to $235 a share. So that was almost a 40% drop. So pretty crazy drop there. And that's kind of what happens with these stocks that are quite overvalued at some points. They can experience massive drops. This is a $74 billion company. They basically just rate credit, they rate bonds. And their price to earnings ratio right now is quite steep at 45, especially for kind of like a low growth industry. I'm not quite sure where the growth comes from in this industry, but yeah, their growth has been okay. I mean, it's still growing, but it's just lower growth, and their growth has been probably about like 8 to 10% a year, I guess. And they actually had a decline in 2022. They haven't had any growth from 2021 to 2023. So, you could say that, okay, if interest rates don't really move much, that means that this company is not going to be able to re-rate bonds, and that means that their revenue growth isn't going to increase. But right, maybe their revenue growth continues at 8%. That's probably the assumption that I would take. And in terms of their earnings, it translates very, very well into their earnings. They keep very consistent margins, and they're usually very high margins at around 30%. They are also, it looks like they're buying back some stock. In terms of their balance sheet, they do have $4.8 billion in net debt, so we do have to take that into account when we do our model. However, it's not bad at all. Let's take a look at this cash flow statement. What are they doing? They pay a bit of a dividend, and then they buy back the rest in stock. It looks like they paid off some debt. So it looks like they're doing good things with their cash. Let's look at the stats here. Their return on invested capital is 25%. However, it has declined over the past couple of years, down to 13 to 15%. Probably just has to do with the market at the time. Their gross margin is very high. Their net margin hovers between about 23 or 24 up to 35%. I think a fair assumption would be 30% moving forward. Let's take a look at what the analysts are thinking for this stock. They're looking at $10.83 a share going up to 12.4, and their revenue estimate 6.55 billion, which is basically a 10% increase this year, and then they're looking at 7.13 billion into 2025, which is like a 9% increase into 2025. So pretty decent revenue growth. However, with their valuation, it's kind of tough to get behind. Let's look at the stats here. Look at their short percentage. Short percentage is very low at 1%. So that is a green flag in their short percentage. Let's look at the model now. This is the model that I have for them. I have their estimates up here. Buyback 700 million. They've been doing between 500 and 1 billion in buybacks, so that's kind of what I put there. Net debt of 4.8 billion. That's their debt right now. Discount rates of 10% because I want a 10% return on all of my stocks, and an exit multiple of 25. I think that's fair because I don't really see that this business is going to be growing. Like, it's not going to be like a strong growth business like tech. And so that's why the exit multiple needs to come down from where it currently is at 40, down to a more reasonable number at 25, which 25 is still quite high because this company has the moat that it has. So I think 25 is completely fair for their exit multiple. In terms of their growth, I have their growth at 9%, slowing down to 8% in their earnings, and even that I think is pretty strong growth in their earnings. And with their revenue margins model, I have their revenue consistently growing at 8%, and their profit margin staying quite high at 30%. This I think is a pretty good assumptions for Moodys. And with these assumptions, we're looking at a fair share price of $291 a share. After their debts, it goes down to 264. Probably putting them at around $280 a share is a fair share price. With them currently trading at 408, they are way overpriced at the moment. Let's take a look at what you would be expecting in terms of returns. Not even 5%, maybe 4%. I'd say you'd probably be expecting about a 4 to 5% return if you were sat in Moodys Corp. Probably underperforming bonds. Like honestly, I probably prefer to buy bonds at this point rather than Moodys, because definitely sentiment can change. Anything can happen to a stock, so you're better off probably just holding bonds instead of buying Moodys at this inflated price. Was there a point in time when they were trading at $280 a share, though? Let's take a look at that. Let's take a look at if there was a time where you could have bought them for a fair share price. And yeah, it looks like you could have bought them for a share price anytime back in 2022. However, yeah, today definitely way overpriced. You could have got them pretty close to fair price in October of 2023. So there are opportunities out there, but not at the moment. And that's what I think about Moodys. Let me know what you guys think in the comments. Let me know if I missed anything. And yeah, make sure to hit that like button. I'll see you in the next video.